What's up, guys? Riz here. Hopefully, you can hear me. We are now live this Sunday, April 5th. Wow, the weeks are cracking away. Time is flying. Um, I hope everything is well on your end. Just let me know if everything is good. You can hear me fine. Yep, I do see some comments coming in. Perfect. Again, right on the money. 8:01 right now. Hope you guys had a good weekend. We're doing another live here, just kind of seeing how markets are going. I'm going to talk to you about what I think the situation is currently, um, and where we can go from here. I want to take questions as well, go over kind of the existing coronavirus situation, although I'm not going to go into it as in detail as I have in the past webinars because I think we've kind of done that. I think everyone's here, I think, to be fair, for the market commentary to see what I think about markets, where they can go. So let's kick things off. I'm just going to take a quick look here, see if everything's good on my end. Perfect. Mike, thanks for joining. Harsh, thanks for joining. I see some of you in here. Victor, thanks guys for joining. Let's kick things off. A lot of you guys are already coming in. Perfect. Thank you for joining me. So, wow, we're in the, I think, fourth. I'm losing track of time. I think the fourth consistent webinar on a Sunday in a row. So, this is something that I usually kind of join one of our traders, Chris, for on Saturdays. We run our elite webinars, but over the last 4 weeks, since this whole coronavirus thing started, since markets really picked up in terms of volatility, I've been doing these public webinars so that everyone can benefit from it, from everyone can kind of get my take on where I think market can go. So you can implement, whether you have experience or maybe you don't, in your trading and investing, and take advantage of the situation, whether markets continue to go up or down. Remember, I've said, if you have the experience, if you have the training, you have the understanding how to approach markets, you can, as a trader, not as an investor, because as an investor, you only buy companies to ride them up for the long term. As a trader, you can actually buy companies and sell them, but on the flip side, you can also short them, or you can make money on the downside. Whether you're shorting an individual stock, you can short the market as a whole and ride this down. I have no doubt that people shorted the market and made money off of this drop. So no matter what situation you're in the market, whether it's the broader market or individual stocks, you can make money on the downside. Give me 1 second, just gonna adjust my lighting here a bit too bright on the eyes. So let's kick things off. The S&P 500, okay, closed at 2488. This is somewhat of a consolidation move over the last few days. You can see in the candles here, for those of you that are not too prevalent I would say, experienced with candlesticks, you can see the last 3 days, Friday, Thursday, and Wednesday, kind of a sideways move. Granted, we had a lot of volatility in between, right? It's only on Tuesday did we have that drop. Or sorry, I would say a sell-off, and then Wednesday was a continuation of a gap down, right? You see this gap down, right? So the market is down about 1.5% this week. Where does that leave us in the big picture? Well, let's measure that right now, right? I'd like to go through this on live with you guys. So where are we in terms of market drop? We're about 26% or so since the peak, okay? Since the peak in the S&P 500. You can see as I scroll out, right? Long-term view. So since about February 19th, all right, which was effectively give or take the peak to where we are now, we've lost about 26% since there in the index. Again, in the index, all right? The peak drop, all right, the peak drop, let's measure that, all right? Same thing, February 19th, and the peak drop was about 35% or so, right? And we've recovered since then, as we're only down about 26%. I say only down, but it's all relative. So let's cut to the chase. Let's cut to the chase because we know markets are impacted. We know that sometimes external factors, and sorry, not sometimes, all the time, external factors have a play in the broader market direction. Sometimes they make absolutely no sense, as many of us saw, whether you've been in the elite chat or whether you're watching markets on your own, you would know that the unemployment numbers came out for this week as well, and they were horrible. I'll touch on that. The new jobs report, meaning how many active payrolls there are in the U.S., that also came out, and I'll touch on that as well. But before we get to that, let's quickly run through the numbers on where we are in the coronavirus COVID-19 situation, because wow, we hit somewhat of a milestone. I don't know if you want to call it that, but over 1.2 million cases globally now so far, right? That includes people that have recovered and people that have also unfortunately passed away. This is the global number that I just recently took a screen cap of maybe half an hour ago, right? So this is relative. I believe this is updated every day or every hour or so. So 1.2 million. I said 4 weeks back, I think we were at maybe 200,000 or something in terms of global cases. Just I'm blown away by this number even now. Looking at it, I can tell you, and I said back then, I'll say it again, this number will get higher. It will go up. It's just unfortunately the case where we're looking at the doubling factor, if you want to look into that. Exponential is also another word we use in terms of cases increasing. Debts. This number was not more than 5,000, 10,000 not too long ago. So this is very unfortunate. It's very disheartening for me, very painful for me to see this number. We're well past 70,000 now globally again, but of course the recovery number is good. Keep in mind that many of these cases, if you do the math, you're probably wondering, well, what about the other 700, 800,000? Well, they're still in that kind of phase. So many health practitioners, I would say disease virology experts, are saying that this week coming up, next week after that, are critical. We're calling it, or I'm calling it, critical mass, in a sense that this is where we're going to get an idea if we're going to be able to start flattening the curve. Now, what do I mean by that? Let me bring up another image for you that have attended, for those of you that have attended the previous webinars, are not unfamiliar with, and this is the total cases line graph here and the total deaths. How are we flattening the curve as a global population is what I'm talking about. Every country has to do their own part. In fact, I have a map of the different states in the U.S. and how they've kind of approached this on a lockdown standpoint. But the global curve has not started flattening yet. We're still seeing that upwards rise. It's looking exponential, continues to look exponential. It's going to take a week or two before we can get a better idea where we stand, okay? And I'm hoping things start looking up. I'm hoping things start kind of flattening over, coming down, for the sake of humanity. But I'm an opportunist in the markets. I may not be overly optimistic in terms of many different things, but when it comes to the markets, the ability for mankind to get through this, I am an optimist. I have the ability to see that we can get through this. This is why I put my money where my mouth is. I literally buy stocks, or I'm putting in capital into the markets. I'm building capital in terms of cash. Why am I doing this? Because if I didn't believe in the system, I didn't believe in these things, these institutions that we have in place, I wouldn't be here. I would just be, off the grid somewhere, right? So you have to understand that in order to first and foremost invest, you have to ask yourself, are you able to sit down and think in your own views, in your own, from whatever knowledge that you have, whether it be extensive or limited, ask yourself, do you believe in humanity coming out of this? Do you believe in mankind, the ingenuity, the amazing individuals on this planet, the healthcare practitioners, the specialists, able to help us? And they are doing everything they can, whether it's on the front lines on a daily basis, or whether it's the researchers, whether it's the people, the experts in terms of diseases and virology and pandemics, able to help us and get us through this, right? So I believe we can get through this, and as a result, I am optimistic on us getting through this, and putting money in the market is my way of betting on that, right? So hopefully that kind of gives you a clarification on my views. Again, I said this before, I say it again. if you think that we're gonna get over this, we're gonna get past this. I mean, yeah, there's gonna be lingering effects. Yeah, things are not gonna go, from absolute lockdown to completely normal how they were 2 months ago or 3 months ago. I'm not saying it's going to be a black and white situation. There's going to be a sort of a sort of a regression. It's going to take time, right, to get back to normal. But I do think it can happen. So if you believe the same, why would you not take advantages in terms of economically, in terms of assets, in terms of wealth now? To me, it's common sense in my view. If you don't agree with me, then that's fair. That's fine. Then of course your objectives are very much different to mine. All right. So those are the coronavirus numbers. That's the stuff in terms of that. Moving on. Something that's still relevant to coronavirus, but more so the states. Let's take a look at, like I mentioned, the states that have enacted a stay-at-home policy, okay, or stay-at-home order. And we know the U.S. is a huge country, tremendously large population compared to other countries, and you can see on a national map here as a kind of identified with darker blue, lighter blue, and sort of various shades of gray, what states have enacted sort of a stay-at-home policy, which ones are kind of giving that statewide order of, hey, stay home, all essential services are open, but everything else needs to be shut. And understand that we have the East Coast, all right, and the West Coast really putting in those kind of mandates. But you see in the middle, you're going to have some states not really taking any action. To me, again, I don't want to upset anyone or stand on anyone's toes, but to me, it's a bit unresponsible. Maybe you will disagree with me, but to me, it's a bit unresponsible in terms of leadership, and it's something I was afraid of. I've been saying since the last month and a half. I've been vocally saying, and it's no secret that I think we have to go through the kind of short-term pain, whether it's economical, whether it's not easy for many to just stay at home, kind of be locked in or avoid going outside. I understand that, but it's something that I think is necessary to ultimately flatten the curve, which I've been saying. But there's still some progress to be made in some states. Again, some of them are not as negatively impacted. So the kind of fallback on that is, well, they're not impacted yet, but could they be? We know how fast this moves. We know all that. I'm not going to get into the whole transmission debate on how it spreads and how fast it can spread, but ultimately we know that an area, whether it's a city or a state that is relatively low on cases, can very quickly change. All right, so I plead with whoever's in leadership, whoever has the ability to take a stance on this, please do your part to, I would say, stay home, flatten the curve, and hopefully we can all get through this sooner rather than later. Moving on, I want to talk to you about the Fed funds rate. This is something that some of you may not be familiar with, but I want to touch on it nonetheless. We know that the Federal Reserve, also known as the Fed, the central bank of the U.S. There's central banks in every country, whether it's Bank of Canada, Bank of Australia, People's Bank of China. The central banks are what I would say regulate sort of the monetary policy. Okay. Again, this is not going to be extensive. I'm going to very briefly touch on this. What we're seeing here since 1999 and onwards, this line here, this sort of block line of what's known as the Fed funds rate. This is the interbank lending rate. This is the rate that banks can lend to each other. We're not talking about the rate that you'll be able to get your mortgage at or a line of credit at. This is the benchmark rate. Think of it like that floor, so to speak. All right. This is the interbank lending rate. As someone who's been in banking, even many people in banking don't know how these things work, but ultimately the way it is what banks can lend to each other to keep liquidity, right? Banks can lend to each other, the Federal Reserve can lend to banks, so on and so forth. And this is, think of it like the floor. And from there on, the banks, wherever you are, this operates the same way in no matter what country you're in. On top of that, they tack on their interest rate, right? So there is the JP Morgan interest rate or there's the Bank of America interest rate on different products, but there's a floor, which is the Fed funds rate. You can take a look from 1999, which is about 5.5%, went up leading up to the 2001 tech boom, 2001 tech bubble, and then it went absolutely decimated, went down '01, '02, to about 1.5%. That was a benchmark rate. We see this cycle continue, right? So this is what I mean by the credit cycle as well. We see the interest rates ebb and flow. But take a look at what's happened since 2008. It's a stark contrast. And if we don't see this past 99, but I can tell you, you go back to the 80s, the 70s, this type of area that I'm, kind of circling with my mouse, that's the singular credit cycle, the credit curve we've been seeing decades before many of us, I would say, were born. That's no longer the case since '08. You can see the Federal Reserve and similarly pretty much every bank in different nations kept their federal benchmark rates at nearly all-time lows, and they kept them there since '06 till 2016. Sorry, when they started increasing, and many different. This curve would look similar in Canada. It would look similar in the European Central Bank, the ECB. And then what happened was in 2019 is kind of things started changing as the economy started getting a bit more frothy, as the economy started reaching what I say peak economic cycle. And from then on, it just took this catalyst, right? So many people think this came out of nowhere. It did. No one anticipated a coronavirus back in November. I didn't. It's only in December when we started hearing about the first case in Wuhan. We're like, what? What's happening with this city that many of us don't know about? We don't even know where it is in terms of China as a nation. We didn't know it was in the what province or what state, and ultimately it just kind of flew everywhere from there, right, so to speak. And here we are. It just took this one single catalyst to sort of what people say break the bull market or break the economy. And I will reiterate that the economy and the bull market or the market, whatever it is, the bear market, bull market, whatever it is, they're separate. Remember, they're related, okay, because you have the economy connected to these major large corporations and businesses. So they're related, but they are separate. You can have a bear market and an economy that isn't in a recession. Okay, that's very clear to understand that a lot of people don't even now. It's important to know that you can have a recession as well, but a market that hasn't hit bear market yet. Okay, most of them preempt one another. So what do I mean by that? We saw the bear market come. We saw the bull market end and a bear market occur. It's not, I don't think, to anyone's surprise. Now the question remains, how are we going to see the economy, whether it's the US economy, the global economy, kind of react? Is it going to contract? And how do we measure a recession? Remember, measuring a recession is different to measuring a bear market. Bear market is 20% drop or more from the peak. And I outlined that for you, right? A recession, on the other hand, is 2 consecutive negative GDP growth. Okay? There is some variance in definitions of that, but that's the most common, often referred to definition of a recession. If you have GDP numbers as a nation decreasing 2 consecutive quarters. So if you have 2 consecutive quarters, guess what? That's 6 months. There is a lag until you see things kind of happen. So for those of you thinking, well, we've hit, peak corona, and, I think it's going to get better from here the moment the U.S. opens up sort of the, let's start getting back to work type of thing. Whether that happens next month or whenever, you have to understand that we're not out of the woods just yet. Okay, it's not a light switch. It's not something you just flip the switch and either lights on or off. It's not as quick. There is a lag in everything that occurs in the economy, for better or worse, so that it gives you some time to react. It has to, because for example, the U.S., you have over 300 million people, right? Everyone's impacted differently. For some, it's a very, very scary situation. Very similar to '08, but also very different, because people's financials and situation has been decimated in a span of a week or two. And for those that haven't been paying attention, they were caught off guard, right? Some of us saw this coming. Now I want to reiterate, what did I see coming? I saw a slowdown coming. I didn't see coronavirus. I didn't see a silent, deadly, invisible enemy coming for all of us. I didn't see that on a global scale. So this is not surprising to me that things have turned over in terms of the economy. There was only so long we could stay at, I would say, 50-year low unemployment numbers. There's only so long we could continue to have continuous GDP growth. There's only so long we could have companies increase their earnings and guidance perpetually year over year. There's only so long things can go, right? And just like life, if you're running a marathon, this is what the economy is. You're running a marathon, you're gonna go in bursts, right? You don't go full speed and run the 10 miles or whatever that is you're running all at once. You can't. You're not. You're just gonna fall down. You're just gonna collapse. So what do is you pick up your pace, then you kind of slow down, right? This is a normal fact of the economy. It's a normal fact of life, I say, right? You have times where you're able to put in a lot of time, a lot of effort, push to the maximum. Hopefully that's in your youth, and then you have times where you slow down, right? And that's what we call, retirement and later age, right? So moving on. Hopefully you guys like some of that perspective there. Give me a minute to, or I would not a minute, but let me take a look and see if everyone's in here. Okay, the chat's going. Again, good sort of discussions here. I appreciate everyone attending. My next, I would say, chart here is on the non-farm payroll. So this is what I meant when I said job numbers came out. Okay, this is payroll numbers, okay, for the 12-month moving average in the blue line. Take a look at that big drop, right? So what does that mean? Simple terms, we lost about 700,000 jobs this past couple weeks. All right, now that's separate. Remember, this is separate to that unemployment number that we saw last week, which increased by 3.2 million, and then this week, which increased by a whopping, I think, 6 million. I think so. Think about it this way: you now have more than 9, I'd say closer to 10 and more, 10 million people, let's say, unemployed now, compared to which was, I think, a couple 100,000 or something, a few 100,000 just before all this kind of occurred. So there's still more pain to go in terms of coronavirus cases. I hope to God that the hospitals are not overloaded as a nation or in different countries. I hope our healthcare workers are safe, healthy, and they're able to get through this. I can't imagine what it's like. I can say I know quite a few. I'm very blessed to know quite a few amazing healthcare practitioners, doctors, specialists in all different areas of healthcare and in different parts of the world. And, I can say for a fact that all of them have the same story. It's very bad out here. That's what they say. And it doesn't matter if you're in some state in Missouri, if you're in a city in Missouri, you're in somewhere in Texas, you're in Florida, you're on the East Coast in New York, it doesn't matter. Or if you're in Canada, or if you're in Europe, in Britain, if you're in Spain, the situation is critical in more places, but bad all around. So, I express my concern, but I also say thanks to those that are doing their part, especially thanks to those on the front lines. I've said this many times, and I think I can't say it enough. For all those that continue to do some amazing work, in different healthcare fields, and whether you're support staff, whether you're, a doctor, no matter what, my sincere thanks to you. And and the people that you all know. I'm sure many of us know someone who's on the front lines, working, putting in these long hours, exposing themselves to risks. So, again, it's nothing anyone signed up for, but they still do it, right? So moving on to the market stuff, I want to share with you, maybe you're an elite, maybe you're not. I shared a public update. I shared this in Elite, but I'm sharing it here because I think it's relevant. This is something I sent this past Monday on my views for the broader market. And I'll break this down for you. If you can read it, that's great. I'll read it as well. Sort of a top-down approach as where I saw things on Monday, right? And where I saw they could go. So let's recap, right? The main thesis is I still believe that the market has some room to go lower. And I said this on Monday, in the short term, just like it has in the last 2 weeks prior. Again, I will reiterate, my SPX bottom, which is the S&P 500 index area, support area being 2100 to 2200 level. We'll look at that. This, I believe, you can refer to as the line in the sand. Okay. Again, I'm reading it off. I'll expand on it in a minute. I think once we get to these levels once more, this is when we can expect a sustained push upwards and a potential recovery in prices to begin. Again, this is medium term. How things shake out 6 months from now, I don't know. We can't even tell what's going to happen for sure tomorrow, right? So this is a medium to short term, I would say, thesis, all right? By contrast, this area, like I said, 2200 area is a great opportunity to load up on some value-based companies. And I've mentioned many to the elite members. I've mentioned some to you guys on live webinar and across my social media channels. Now, with that said, this is the main thesis. I'm very well aware that it doesn't have to go like this. I'm not some oracle. I cannot tell the future. So what do we have to do? We have to have contingency plans in place. We have to think of it like a flow chart. If A occurs, then I think B will occur, right? If A does not occur, what do I think will occur in terms of C and D and so on? So there's two suboptimal theories that I kind of outlined for my members. And I said, if theory one breaks or we don't see that occurring, well, then we may need to look at the suboptimal theories, which is 1 and 2. So what is number 1? If we see a continuation, this is me talking about Monday and talking about the weeks prior. If we do see a short-term recovery, we see the index moving up to the 2700 area, and it can hold that level, well, then that means the market has moved past this broader sell-off for the time being and potentially is on its way higher. All right. Suboptimal theory number 2. If the market indeed breaks the 2100, the line in the sand I mentioned in the main thesis, well, then guess what? We're in for a lot more further pain in terms of the broader stock market. Okay. And it has the potential to go lower. So hopefully you read that. Hopefully you followed along. Let's digest that and kind of extrapolate on that visually. So this chart, like I mentioned in the beginning, is the S&P 500. Take a look where we are. This is the daily chart. It seems almost like forever that this bear market's continued, but no, it's only been about give or take a month or so, right? So we're still in the thick of it. You know, bear markets we know can last on average about a year or so. Again, it's not a precise metric, but give or take, they can last for some time. So reasonably speaking, if we know they last a year on average, we're only 1/12 the way. So, you know, we may be in it for quite a bit longer. And of course, we've seen massive recoveries too, very, very quickly. And to put that in perspective, although it wasn't as bad, it wasn't I would say a clinical bear market back in 2018, but we did see a big drop in the index and then it's even faster recovery, right? So that's that V looking shape. I don't think we're going to see that this time. I said that before, and I still believe that we're not going to see it, you know, a recovery just like that. So without further ado, not mincing words, where do I think we can go next? I think there's downside. Where we are in terms of futures, I'll bring up FinViz. This is where you can see futures pricing. I'll just show you visually. Take a look at this. This is the S&P 500 futures. Futures open 6 p.m. God, the ads are really bad if you don't pay for FinViz. But here's the futures up 2.9%. So I look at the S&P 500 futures. There's Dow and Nasdaq futures, but the S&P 500 index is my kind of bread and butter, and that's up about 2%. Right now, things can change overnight and until pre-market open at 4 a.m. Eastern, but that's where we are right now. Take a look at oil. Oil is another thing we've been tracking and trading in Elite, and it's down about 8% as of right now. Again, futures oil markets have opened as well, and that is because the market was expecting a deal or some talks to occur tomorrow between Saudi Arabia, different oil OPEC countries, along with Russia, right? So this is where we saw this uptick in oil. This is the oil crude pricing right here. Okay, $26 a barrel. $26 a barrel. And just up until last week, we're about $20 a barrel. So a great rally this past week in oil, which we rode up, but it's going to be down, right? It's going to be maybe down officially tomorrow if we were to look at U.S. Stocks, oil stocks, or if you were to look at USO, which is an ETF that we started trading. And here, I'm giving things away a bit. You can see I'm actually on the wrong chart, but either way, I was going to show it to you on this one, but hey, whatever. I was going to show you on this one where you wouldn't see the indicator because that's for my students. But here, giving it away here a bit. But anyways, you can see the Alpha Cross Evo, the Riz Alpha Cross Evo, that's my proprietary indicator. We give a long signal on a daily chart on USO, which is oil. I think, that's a big tell, but again, the indicator cannot preempt Saudi Arabia and Russia meeting or not, or in this case, the meeting being canceled. The meeting got canceled, and it may be pushed off further, hopefully in this week. We don't know. This is why oil saw that 8% drop in the futures market. What I'm thinking in oil is I'm gonna likely buy some more. I still have some, oil related positions. I'm okay with holding different solid companies that they're not going anywhere, no matter they are beaten very badly. Think Royal Dutch Shell. All right. Where is it? There we go. Royal Dutch Shell. Beaten up again. The indicator was there. I'm showing it to you because I'm being transparent, sharing with you guys stuff that my students have access to. But it really, I think it's a great opportunity to get into some of these names, whether it's Exxon as well, coming up, right? Also, you saw it on USO, which is the ETF that tracks the oil price, right? I still hold both. To be honest and transparent, I hold both. I continue to hold both, and depending on what happens, I may add directly to oil positions via the ETF and or the different oil-based stocks. All right. So back to the S&P 500. I'm going to show you this chart here. I have the Fibonacci levels. It doesn't really matter too much in the grand scheme of things. I just have them for my kind of visual sense, but you can see that I just mapped it out where the market kind of can go in terms of the 2100 area. And I'm serious about that. I didn't just pull it out of my ass. There is some precedent for this, and I'm not going to go into the weeds of it, but we do know that 2200 is that floor area that we hit in this big drop off. I know it's hard to see because volume covers it. See if I get rid of that. There you go. Right. So we know this is that drop off. Volume was covering it, but 2200, like the market hit about 2200 on the index and then picked up. And I apologize if it's hard to see, but here we are. Right. This is the same chart as I showed you here. So same thing, just looks a bit different. A lot more stuff on screen. Right. So same thing. Okay. We're right now at 2488. The futures are up to 535. So realistically speaking, tomorrow we could open somewhere around here. Okay, that's a horrible circle. Somewhere, I'm just gonna do a line somewhere around here. Okay, if futures open where they are. Okay, and oil, if oil opens where oil futures are, we're going to see a downtick in 8%. In fact, let me bring up the crude price, right? This is real time. So this is already adjusted. You can see it's down here. It's already dropped from Friday's levels, right? So this is already dropped. So moving on to the S&P 500, where do I think we can go? Whoops. I'm going to switch it back here so it's a simpler chart for you guys to view, so I can make some drawings, lines, whatever on here. So here's what I think can happen in the short term, medium term. This is my main thesis. I'm visually representing it to you, that portion that I read out not too long ago. I think the market can go lower. It's not going to look exactly like that, of course, but I think the market can go lower. Even if we move up, we can see something like this occur. Okay. And don't be fooled into thinking that this is one big giant rally setting up. I do not think so. I can be wrong, but I genuinely do not think so. I do think, the 2,500 level where we've kind of been before, all the way to the 2,700. Remember, I mentioned that the 2,700 area is that area where I think if we break past, then you might see more of a recovery. Just going to see momentum going in. But like I said, I do see more downside, and that is towards the 2,200 to 2,100 area. Okay, so we draw that here, and here. So maybe you want to visually mark it on your chart or make a note of this. 2,100 on the S&P 500 to 2,200 is that area, and that's the one that I think you have to be paying close attention to, because my main thesis is still in play. Although it didn't, there was talk in Elite when we're like, shit, this thing is kind of moving. Is it going to get to that 2,700 level and break above for that suboptimal theory 1 to come into play, right? This would be suboptimal theory 1, S1, all right? If it broke, I apologize for that. I could use the text tool, but let's roll with it. That's the S1. If we see the S&P 500 continue to break above 2,700, we could continue to see a rally. Okay, my main thesis, which is going down to 2,100 to 2,200, that's what I've drawn here. Okay, maybe I should use different colors. Again, doing this live, I hope it helps. I hope it is kind of visually explaining to you what we can do in terms of broader market. Again, individual stocks, you have to understand, most large caps will move with the market. So if people ask me, Riz, what do you think about XYZ or ABC? Well, in this environment, it doesn't necessarily matter what XYZ company does as a business or ABC company does as a business. It's all moving with the market. Again, this is for large caps because the broader market is down. There's a systemic reevaluation of what the economy is, what the market is across the board. All right, this isn't specific company related. It isn't specific to Apple. It isn't specific to Microsoft. It isn't specific to Exxon. It's on a global, I would say, the broader market as a whole. So when I say the market can go up or down, that in contrast applies to a broad basket of stocks. Okay, whether it's airlines, even, if we see it further drop in the broader markets, guess what I'm saying? I'm saying that Apple can go lower. I'm saying maybe airlines can go lower, cruise lines can go lower. And before someone says, Rich, I have Delta or I have American Airlines, I have Southwest Airlines, should I sell and then rebuy at the lower point? No, I get asked this question. I don't want to seem like I'm annoyed. I don't like this concept of should I sell and then buy back lower. There's no guarantee that can happen. Okay, I wish I was able to see the future. I can't. So if you have the ability to hold for long term, that you should hold for long term. If you're gonna get scared out, then you should have gotten scared out a long time ago, right? So it makes no sense. If you take a loss on a tax standpoint and you buy back and you make money on the trade, you're screwing yourself over on tax standpoint. I'm not going to get into wash sale rules. I'm not going to get into capital gains or capital loss. I'm not going to get into that here. But there's a reason why I say if you're holding something, you have the ability to hold. From a risk management, from a position size, from a time frame, then you hold, unless you're holding some garbage penny stock, which you're stupid for doing anyways. But if you hold something, okay, that's a valuable business, like an airline that reasonably speaking shouldn't be going anywhere. I don't think all airlines are going to go under, just like I didn't think all banks would go under back in 2008. Which ones remain, which ones don't, remains to be seen. But if you hold these things, I don't care if it's Delta, I don't care if it's Exxon, Royal Dutch Shell. If you hold these things and you believe in the business and you believe in riding this out, there's no reason to sell because it's gone down another 10%. And I'll also speak to one of my recent posts on social media about Warren Buffett selling some of his shares. I can guarantee you that Warren Buffett still holds many positions. So his Delta Airlines stake, for example, large position. Warren Buffett actually bought a metric fuck ton of airlines not too long ago. he trimmed his position in Delta by I think 14 or 18%, something like that. Now, does this mean, oh my God, we should sell Delta Airlines because we hold some? No. Warren Buffett's positions, his portfolio is very much different to yours. I guarantee you he has hedged his positions. I guarantee you because he sold, he actually did this a while back. You're just finding out now, okay, based on filings. He actually did this a few weeks back. All right, beginning of March, actually. So we're just finding out now. So does that mean you chase Warren Buffett's move now? No, you're a sucker if you do that. If you follow anyone just blindly, okay? It's important to follow people that I would say know what they're doing, but never do it blindly, even if it's me, right? So ultimately, no, do not sell your position because XYZ person sold it. In Warren Buffett's case, he sold 18% or so. I'm telling you that he's doing it because he might have gotten, assigned or called on one of his positions. Maybe, like I said, there's many different ways of hedging yourself that these large funds, these large institutions, Berkshire Hathaway is a large investment firm. So there's no doubt they're using all kinds of tools and financial products to leverage themselves in the situation. If that means hedging, if that means buying more, if that means consolidating positions, it's all fair game, right? So please do not follow a large, I don't care if it's a different hedge fund, I don't care if it's Bill Ackman, please don't just follow blindly because one, you don't know what their broader portfolio is, you don't know their thesis, you don't know what other position they've already taken. Warren Buffett could have taken that, position of selling 18% of Delta and bought another airline. He didn't, he sold other ones too, but he could have bought something else in place. You don't know that, right? So don't blindly chase. Understand that I hold Delta Airlines still. Again, I put my money where my mouth is. I don't hold Southwest or American Airlines, but I do hold Delta. And I can't tell you what to do, but I can tell you what I'm doing, and I still hold. So don't follow me blindly, but please understand that if it's suitable to you to hold this, I don't think Delta is going anywhere in terms of going bankrupt, if that's what your concern is. All right. I got a bit sidetracked there. I apologize. Suboptimal 31, I told you if we go past 2,700, I think you can see markets recover to about 3,000 area or more. Doesn't mean the rally doesn't mean the bear market's going to be completely over or the economy is going to recover right away. No, I think there's a lagging factor. I think this drags into the summer. Absolutely, this drags into the summer on an economic standpoint and even as a market standpoint. I think markets can continue to linger and go lower. I said that before, seeing it again. This area, 2,100, 2,200, that's my thesis, okay? On second thought, let's type this. That's my thesis, okay? 2,100 to 2,200 area, okay? That's my main thesis, right? I stick by that. It's on video. We'll see how things shake out. Can I be wrong? Abso-fucking-lutely, I can be wrong, all right? Suboptimal theory number 2. This can also occur, all right? Keep in mind, my main thesis is still in play. Suboptimal theory number 2 is... There it is. This fucking thing moved on me. There we go. Suboptimal theory number 2 is that the market goes below 2,100, below 2,000, and continues to go lower, right? That, I think, is a possibility if we break below 2,100, all right? And I'm going to mark that with the white. Okay, I apologize for this crude drawing, I really do, but hopefully you get the point. It can go lower. That's my take, all right? And of course, I'm going to react that way. Let me clarify. I have two styles of trading, or I would say two styles of market participation. One is trading, right? In and out, taking advantages on the short to medium term on the upside, stocks going up, but also on stocks and markets going down. That's trading. Investing, okay, I also do this. This is done in a different portfolio where I hold solid companies or take advantage of these very drops, add in, continue to hold throughout. So there's two sides, okay? There's two sides. My investment side, I bought some. There's a great list I shared with my elite members. I even shared some of those names on different channels on social media of companies that I've bought, added to, and continue to hold. That hasn't changed. On the trading side, I've bought some. I've exited some last week on the bit of the rally that we had, right? We had this bit of rally up here, and then I sold. In fact, I closed out quite a bit of my long positions in the trading account. Remember, there's two separate things, so you always need to keep in mind. See, even for me, things change. So you need to know where my actual positions lie, not just my thesis, right? Where are my positions from a trading or investment standpoint? So what applies to Warren Buffett in terms of his portfolio can apply to anyone. You need to know how someone's portfolio is structured before you just follow them blindly, right? So on my investment positions, I continue to hold, I've continued to add it. Nothing's changed there. Let's move that to the side. Trading, which is what most of you are interested in the medium term, I took some long positions in Intel, in things like I have to take a look, but really I had some positions in Intel. I had some to actually be transparent. I'm going to share with you what I actually held and sold on Friday. Okay, I shared this real time with my elite members, but I'll tell you right now what I sold. Okay, closed out positions in Cisco on Friday. All right, for profits. These are all for profits. I locked in some profits, took off some exposure. Right, I'm not going to get into what I mean by that, but I took off some profits. Cisco had a nice run since I added in the trading account. Took that off. Took off Micron. All right. Again, I'm kind of playing my hand here, sharing with you guys. Full transparency as always. Took some profits here. Sure, I could have got out here, but that's hindsight. I decided to let it run. Still got out for profits. Intel, I mentioned, here's a chart. Intel, I also took off for profits, looking great. Decided to take off exposure. 3M as well was one. You can see I've just taken these off on the rally and on a profit basis. I had a profit, so I took them. There's positions that I still hold in the trading account that are in the red, that are in a loss. I'm okay holding. That's fine, right? I just decided to take off these profitable positions and hopefully re-enter depending on how markets go. Because remember, if my main thesis stands, which it does, that markets are going lower, it makes sense for me to lock in profits and reevaluate for this week. All right. KO, Coca-Cola, another one that I closed for profit, right, on this rally up. And lastly, J&J. So this is another one that has done really well since the big drop. So understand that you can do well in some trades and take advantage, and then other trades may be languishing, and that happens. There's no singular thing unless you only trade one stock in your entire portfolio, right? I spread the love. I do it in terms of diversification, whatnot, and I closed some of the profitable positions. I still have oil open. I'm probably going to add, like I said, I still have Exxon open in the trading account. Royal Shell in the trading account. Going to add more perhaps. I still hold it. There's some positions that I still hold that I will continue to hold until I think it's prudent to sell. And I'm not averse to selling and taking a loss. I just don't think I'm at that point yet, right? So everyone's different. So that's my disclaimer there. Everyone's different. I tell you how I operate and what I think is right. I'm hoping you have the ability to make that decision, make sound financial trading decisions on your end. This is why it's so important to know what to do, know about risk management, know when to exit trades on a disciplined method, not just riding some hot tip or what Warren Buffett did in his $100 billion, $200 billion portfolio or whatever. Okay, so that's that. Let's bring back to the SPX to kind of just cap things off. All right. So to wrap things up in terms of a technical standpoint, markets, main thesis, still in play. Remember, we are right here. Okay. We are right here in terms of where markets are. They can still go lower. I don't think we're done with the coronavirus yet. I said the numbers will go up in terms. Don't be surprised if we hit 3 million cases very soon. This is not some stab in the dark. It's going to happen very soon. I said that when we're at a couple 100,000 cases that we're going to go up and continue to go up. And I tell you right now, we're going to hit 3 million very soon cases. Does that mean, oh my God, we're going to hit 3 million, the market's going to collapse? No, the market does care about cases, but it doesn't move one to one. All right. So Main thesis 2100 to 2200 area. Again, it's not a precise metric, but area for the S&P 500 index is still viable. I think it still happens. I can be wrong. If that doesn't happen, then two things can occur. All right. Remember, think of it like a flow chart. Two things can occur if my main thesis doesn't. That is, we continue to rally and move past the 2700 area, and boom, it continues until it doesn't. Or what happens is we hit the 2100, 2200 area and we break lower. That's when we're in for more pain, as I've kind of said here. I've just drawn it to 1900. That's a really, really big drop. There's 2016 levels. Okay. Is it possible? Yes. That would be a really big drop. We take off, completely. Think of it like we just take off 5 years. Literally, that's what it is. You're taking out 5 years or so in market gains as an index. Okay, remember, these large companies like Apple, so on and so forth, can drop even more. Does that mean you do not buy now? No. That's why I've been saying, take starter positions. If you don't know what starter positions are, I'm not going to go into this on this webinar, but really, starter positions are great. You have an underlying position that I think you can work with, and I do the same in my trading account and investment account. So Apple, as contrast, think of it, as one of the largest companies in the U.S. Index, can go lower along with the market, just like everything else. Doesn't matter what it is. When I use the market, please use that as the ability for every other stock in the large index to move with it. So when I say SPX going down to 2100, which is potentially another, that arrow is getting in the way, but let's say another 11% drop. Okay, guess what? Apple, by contrast, can drop even more than 11%. Remember, if the market as a whole is dropping 11%, Apple can drop even more, and that could be 15%, 20%, right? So maybe Apple goes below 200, maybe Apple goes to 200, 190, so on and so forth, right? So hopefully this sheds some light. I wanted to be more thorough on this webinar. I know I go over a lot of stuff, but hopefully this gives you a full, I would say, large picture view on the Corona side, on the broader market side, my positions, my insights. I throw everything at this. Hopefully you guys enjoyed it. I know I've done a lot of talking. Holy crap, we're an hour in. I completely lost track of time. But some of you are still on here. I appreciate that. I haven't been going through the chat. Absolutely, let's take some questions now. Let me see what we have here in the chat menu. Futures are now up 3%. Tyler says, let's take a look. Yeah, look at that. Pushing past above 3%. Tyler, good. Crude oil now down 5%. Fuck off, ads. So really, tomorrow's look is super bullish. So there's a lot of whipsaw, and I say this all the time. I sound like a broken record continuously this past month. So much whipsaw. Like, look at these fucking candles. Like, anyone, guys, by the way, anyone that tells you, oh, I am Mr. Joe Blow, day trader or swing trader, and this is an amazing environment to trade. No, fuck that. The guy's a liar, or a girl, whoever. It's very hard. I don't care who you are, how long you've been trading. It's very hard to trade in this whipsawing market. You have green, 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 then you have red, red, red. You have green, red, green, red. Like, it's just ridiculous in terms of markets, what I mean. And like I said, because everything goes with the market as a whole, because it's part of the market, guess what? You're going to get whipsawed. And you're using stop losses and you're trying to do that. Man, I'm telling you, everyone's having a really hard time. They may tell you one thing, but the reality is very different. Okay, this is why in Elite, I've increased the time frame. I've decreased the amount of trades. Why? Because I'm doing this for myself, and I think it's prudent for my team, my members, to be doing the same, right? I do what I say I do, and by contrast, if I believe in it, then I recommend you do the same. If I don't, then I won't tell you to do it, right? So understand that if you're actively trading, maybe if you're day trading on a very microscopic level, then that's up to you. But on a swing trading standpoint, try and maybe elongate the time frame, decrease the trades, protect capital. I've said it across all my channels: protect capital, preserve capital. Contrary to belief, it's not my job for my elite members or alpha members or students to help them make money. Uh, I genuinely believe that it's not my job to make them money. They're not, a managed investment client for me. What is my job is to educate them, to tell them what the realities in the markets is, and help them. Okay, educate them and help them protect their money. Okay, that's key, because believe it or not, most people that get in the markets lose money. So why would I not focus on that? That biggest problem area, which is many people getting into this and losing money. So that's where I focus my teachings. That's where I focus my time, helping people not lose. Because by contrast, if you're not losing, A, you're retaining capital, and B, you can now put that capital use, I would say, in a better way, right? Every dollar saved per se is a dollar earned. So that's my mantra. Think about it that way. Let's take some questions. I'm going to take some questions now. Let me go up. Let's see. All right, so I'm going to start with this one by Hamza. I've done well with SPX and SPXSL lately. What is your thoughts on holding SPXL long? That's the leveraged S&P 500 bullish ETF. Okay, we've traded these. Yes, not a bad idea. Of course, if you're bullish on markets, absolutely, right? Instead of buying the SPY, which is the S&P 500 ETF, you're buying the S&P 500 three times leverage bullish ETF. Again, be careful of holding this if we get continuous drops. Why? Because it's a three times leveraged ETF. It will decay if you hold. The more data points you have, the more decay you will have from the time that you bought. So let me rephrase that. If we see markets continue to rally and move up, you're gonna do exponentially well, because you're three times more leveraged, right? For every dollar you put into this ETF. On the flip side, the moves will also be larger if the market drops. So understand that if you're wrong and markets continue to drop, you need to exit sooner rather than later. Okay. If it's going up, you'll do really well. You can let the position run and then set stop losses or areas where if the market curls back, at least you get out for some profit. You don't give it all back, because as we know, markets can whipsaw like a mofo, and that's what they've been doing the last month. Huge volatility. And another tidbit I'll give you guys: bear markets are conducive to excess volatility. You'll see more volatility in bear markets than you see in bull markets. Like, bull markets are easy. Oh, they're just every day is seemingly up and up and up. So you just buy and it goes up. You throw a dart at a dartboard with a stock on there and it goes up. That's very similar to what happens in bull market. Bear markets, things are a lot trickier. You get a lot more volatility. Look at the candles, right? You can literally see the candles and the gaps compared to, something like a year ago, right? Not too much volatility. It just kind of goes up, trickles up, right? So there's another saying in markets, stocks take the stairs up and the elevator down. I think no more is it true than now, where you can see that, right? They take the stairs up and the elevator down. Okay, so Hamza, great question. Let's continue on. Thoughts on CNQ? Absolutely undervalued. I hold some. I hold quite a bit. I've added some to my positions over the month. Where can you learn about getting taxed in multiple trades instead of investments, for example? The what's it called? IRS website is good for capital gains tax, looking into how that works. If you're in the States, if you're in Canada, the CRA website, it all depends where you are. The reason I don't get into taxes is because A, I'm not a tax specialist. B, I deal with thousands of people across a year, tens of thousands, and many are from all different countries. So me telling them how Canadian tax rules work is irrelevant to how tax rules may work in Venezuela or in Spain or in a different European country or even in the US, because the tax how taxes are calculated on trades and investments are different from country to country. All right. So hopefully that helps. Where do I see markets going if they break below 2100 support? A lot lower. That's where it remains to be seen, right? It's like the best example I can give you is, you know, if you let a car roll on a decline and you get out and you let it roll, you put it in neutral, you let it roll. Well, when is it going to stop? It's going to stop sometime. We just don't know when. So that's my best analogy. Okay. One thing I will say is maybe I think a 2000 area would be next. That's another hard level. Okay, just think of it like a whole dollar mark in stocks. That's a very, very important level in the S&P 500. Do I think we'll get there? Remains to be seen. Someone is asking me, do I use oscillators in technical analysis? Yes, an RSI is an oscillator. I don't have too many indicators on my screen, but I do have some critical ones. You saw that in terms of the RSI. The RSI is an oscillator. I use it. The definition of it being an oscillator actually is it's cagey, but I do use that. I don't use too many others in terms of indicators, oscillator or not. So I don't use like the commodity channel index or the different. There's like hundreds of different indicators. So someone else asked me CCL, Halliburton. CCL you have to be careful with. I mean, great long-term opportunity if they can survive. Okay, I doubt they're gonna get any bailouts. I doubt any cruisers are gonna get bailouts. You can see it's been decimated. If they will survive, this applies to RCL, so on and so forth. If they can survive, yes, tremendous upside for the long term. Don't expect this to turn around too quickly. Again, I'm not talking about intraday gains because that's a different story. Halliburton, I prefer Exxon, I prefer RDSB, I prefer those kind of plays as opposed to Halliburton or Occidental. That's me personally. Okay. Do I think it's a good time to get into retail stocks like Walmart, Costco? I would hold off. Okay. The reason being they're probably gonna do really well. Honestly, they're gonna do really well on their earnings. We also know one thing I forgot to mention is earnings are coming. We're almost in earnings season, right? In the next 25, 30 days. You can see, right? For example, Walmart, earnings are supposed to be on 19th May. And these retail stocks like Costco, Walmart have done relatively well, right? I'm going to bring up Costco here, right? Similar story. Look at May or June, beginning of June for Costco. But yes, I think they're going to do well on earnings. I just don't like buying these just yet because they've done really well over the years. They can continue to do well. I just don't like buying stocks for long term. Again, trades are different story. For long term, when I don't get an increased margin of safety. What do I mean by that? I'd like things to be further discounted. All right, for an investment perspective. Trading perspective is completely different. Well, trading perspective, someone would say, oh, here's support. Oh, it's consolidating now, so there's going to be a large move in one direction or the other, which very well could be true. I think this is okay for from a trading perspective, leading up to earnings. You get in, take some moves up, perhaps, you get out, take the money. From an investment perspective, like I said, I'd rather wait and see what happens. I'm not a buyer for these retail stocks yet. I think the time to buy was last year. I did, in fact, in the Alpha portfolio, and in Walmart was one of the names we held, and we sold it for profit, right? So that's that. Next question. Any thoughts on NRZ? Sorry if I take too long for these questions. I apologize. New Residential Investment Corp. A REIT, absolutely hammered. Yes, if you have the risk tolerance for REITs, if we see a recession, a formal recession, remember what I said, continuous negative economic GDP growth for 2 quarters, you can see REITs continue to go lower. Many of them will be at risk of going under, especially the ones without great balance sheets, without great, you know, properties, and I would say a lot of safety baked in, because the REITs that were tremendously leveraged in a very risk area like mortgage REITs, well, they're going to be at higher risk, because guess what? When you have recessions, especially ones like this, where people are unemployed on a mass scale, what happens to mortgages? What happens to things like that? People default. People can't make rent, or people can't make their mortgage payments. So those are at even more risk. NRZ, I do not hold, but if you have the risk tolerance for it, it may be a good buy. It's gotten slammed, but it's gotten slammed for a good reason. It's I don't know it too well, but it's does property management, blah blah blah. I'm assuming they're probably gotten sold off simply because they also have a lot of exposure to leverage and perhaps even mortgages, and they are a residential REIT, so automatically I can tell you they have a lot of exposure to mortgages, right? Because maybe they hold multifamily condos that people buy into, or so on and so forth. So there's massive risk there, and you could see that's why the stock has gone from 17 to $3 and something. Okay, what do I think about silver? What do I think about silver? Silver is is a tricky one. I think it can go where the heck. We'll just bring this up. So silver is a tricky one, very similar to gold. I like silver in terms of movements, because if gold goes up, silver will go up. But think of silver like more of a leveraged kind of oil trade, gold trade. It's gonna move with other precious metals, right? So I'm not a holder of silver or gold right now. I'm not too big a fan. I've been staying away from precious metals for the last little while. And just like crypto, I'm not too big on them, right? They can be a good hedge for inflation, which I think will go up now that the Feds and the Treasury's been pumping and printing a lot of money. But it's up to you if you think if it's prudent. Um, Someone asked me what they asked me. Yes, good question. Mark asks consequences of short and long term, the money being printed by the Fed and so forth. Yes, so without going all, extensive and using a whole bunch of finance and banking jargon, I will say that more money being printed increases inflation. The Federal Reserve knows that, but they have no choice. Why? Because they need to print more money to buy assets. Now, what assets? I'm not talking about stocks. The Federal Reserve does not buy equities, which is stocks. They instead buy treasury bonds. They buy different bonds. They can even buy corporate bonds, right? Different areas of debt products. That's what they buy. They print money so they can buy more various different types of credit products. What does that do? That puts like a floor. It puts some buying pressure so that these things don't go to zero, right? That's what they're trying to do. And they're trying to effectively print money so that they can then pump into the economy via stimulus. What are we seeing with stimulus? What is that? That's going to increase inflation to a certain scale. What's going to happen in the short term? We don't know, because these things all have, they all operate slowly. They all happen with time. These are not things that change in a day or even weeks. They take months to factor in. And I can tell you the way things have worked prior, this is unfortunately needed. The Fed has already dropped interest rates. What are they going to do? Negative interest rates? We know they don't work too well, as we've seen in Europe. This is really their only tool in the toolbox. Printing more money and giving people checks or whatever, right? I get it. I get it why they're doing it. How it's going to factor into the markets. Remember, inflation at 2% to 3% max is okay. Above that is not okay. So remember, everything is in certain levels, right? There's no precise metric. So if we have inflation levels go up above 3%, that's not ideal. And as a result, what's going to happen is gold, different, I would say, stores of value like gold, silver, so on, will likely go up, right? We've seen in the past when inflation rises out of that channel of 2 to 3%, different commodities like gold, like silver, even oil, right? They go up. Okay, so that's my 2 cents. Uh, Clayton, thanks for joining, brother. A lot of you have been here for some time. Thank you. Walter asked, Suncor be a good time to enter for investment? Yes, Suncor is great. It's had a nice rally. Sorry. Uh, right, has a nice rally the last couple of weeks. Yes, I think it's a good, great company. It's the Canadian, version of, think of it like Royal Dutch Shell or Exxon. Okay, so if you have exposure to Canadian markets, the TSX, yes, it's great to get in with those Canadian dollars. All right, we'll leave it there. I think those are some questions. I hope I answered all of them. If I didn't miss yours, I apologize. Um, we'll leave that there. It's been an hour and a bit. Thanks again, everyone, for joining. Please share this, like, subscribe, comment. Really hoping to increase the video content that we do, not just in terms of webinars like these, which I think are very important this time, but just general market related videos, giving you guys more insights, more content, more free content, more valuable content that I think is missing and genuine, right? A lot of this stuff is clickbaity and all bullshit. I want to change that, like I've done across my various different industries. So thanks again for being on. I appreciate the support. Much love to you all. Please stay safe, stay healthy, look after your families, make the most of this downtime. I know not everyone is free and has nothing to do. A lot more people are actually more busy. Case in point, our healthcare workers. I'm more busy. I'm more busy this month, this past March than last March. I'm more busy this past month, so I'm not gonna complain. But yeah, some of us are more busy. So no matter what your situation is, make the most of it. Invest in yourself. Do the best you can in these trying times. We'll get through it. Much love to all of you for your support. Thanks, and have a great rest of the night. All right, take care. Bye.